Hello, everyone. Am I audible? Please unmute yourself to respond. Great. May I ask the video to be started by the IT? Okay. I think it has been enabled. Right. Today, the occasion is that LIC Mutual Fund is coming up with an NFO, or the manufacturing fund. We have the pleasure of having with us the co-CIO equity, Mr. Nikhil Rumta, and their business development head, Mr. Sailesh Mehta. Now, first we are going to hear out from Mr. Rumta in terms of what the fund is about, what is the investment process, and followed by that, we can have a brief few words from Mr. Sailesh, and followed by that, we can have a question and answer session. But before I request Mr. Rumta to start about the manufacturing fund, I would like to share briefly about his background, a brief introduction about him. He joined LIC Mutual Fund in 19th June 2024. Before that, he was with SBI Pension Funds as Fund Manager Equity. He has spent some time as CIO Equity in Golden Myriad, a Garware Group family office. He was also a co-fund manager and research analyst with Nippon India Mutual Fund. Prior to that, he was with Bajaj Allianz Insurance Company, Life Insurance Company, between 2016 and 2019. Prior to that, he was with Anand Rathi, Standard Chartered Securities, and Religare Capital Markets. So it's a considerable and vast array of experience that he has. Being from the fund industry, he is definitely known more, to be a champion in the small and mid cap segment. And there's a lot of anticipation and hope in terms of turning around the equity fund side, particularly in LIC Mutual Fund, and more so from this particular NFO that we have in upcoming. So without taking much of your time, I would request Mr. Nikhil Rumta to take over and introduce us to LIC Mutual Fund and LIC Mutual Fund's NFO, the manufacturing fund. Thank you.
Thanks, Shashank. Indeed, a pleasure to be a part of this esteemed organization and the crowd out here. Thank you once again for giving us this opportunity.
Just give me a moment. I thought Nikhil would come on. So I'll introduce to all of you.
Yeah.
Mr. Sailesh. He is heading the business development in LIC Mutual Fund. He comes with a vast experience of almost 2.5 decades in fund management industry, having spent considerable time in Tata, ABN AMRO, and various other top league asset management companies. He is currently also responsible for not only for business development, but also for alliances for national distributors and partners like us. And there's going to be a lot of engagement from us with Mr. Sailesh. So welcome aboard for this webinar, Sailesh.
Thank you, Shashank. Thank you for this lovely introduction, and thanks for giving us this opportunity. The occasion is for the launch of our NFO LIC MF Manufacturing Fund. And as far as manufacturing goes, I think this perfectly matches the Atmanirbhar and the Amrit Kal theme of the Government of India. Anything which matches with the government's philosophy has to grow. And if India also has to grow, it has to be on the basis of manufacturing. Today, if the contribution of manufacturing is 17% in GDP, it is expected to go up to 25% in 2030. And if we have to achieve the aim of a $10 trillion economy, it has to be new themes based on manufacturing platform only. So without taking much of the time, I would now urge Nikhil to take over and carry forward this presentation. Is that okay, Shashank?
Yeah, absolutely, Sailesh.
Okay, so over to Nikhil. to continue on the manufacturing theme and the fund.
Thank you, Shailesh.
Thanks.
Yeah, hi. Thank you, Saliji. Thank you, Sashank. And good afternoon, everyone. So, as Sashank mentioned, I have to take you all through our processes as well as through the manufacturing theme. So, in terms of process, the first thing which, I get a question basically, am I growth oriented? Am I value oriented? What type of focus do we have? I say that we are a research oriented fund house. We are a 15-member strong equity team. And in terms of per equity team member, our AUM is just 1,000 crores. Why is that important? This is amongst the lowest in the industry, and hence we get significant amount of time to do our deep dive research. Second, every person from CIO level to analyst level is part of research, including myself. When a CIO does a research, it boils down it culminates in the culture of the department. And third, the average experience of my analyst, around 15 years. The total experience of my investment department, 200 plus years. So these are the three key things which we as LICMF have built over in the past couple of years, which are unique as of now. Last but not the least, in terms of focus areas. So Peter Lynch said once, in the business of investing, if you are correct 60% of the time, you are through, you are successful. I say that means out of 10 scripts, 6 need to be winners. Let's not talk about those 6 which are winners, which are part of everyone's portfolio. Let's talk about those 4, the misses. If I am able to cut down those 4 mistakes to 3 or 2, my success ratio increases from 60 to 75. That's what we focus on in LIC Mutual Fund. We do the same thing in a different manner. काम वही है, देखने का नजरिया अलग है. Coming to our LIC Mutual Fund Manufacturing NFO, 2-3 key things which I'll answer here. One, we are the 7th or 8th one to launch this NFO in the past 1.5-2 years. Of course, 2 of them had launched around 5-6 years back. Why now? And why LICMF Manufacturing Fund? Why now? Because we believe that for manufacturing, it's not just 1.5 to 2 year story. It's a long drawn process. It's a 5-year, 10-year, 20-year story. India have to become a Viksit Bharat by 2047. So our GDP per capita have to increase from $2,600 to $18,000. Huge opportunity. It's not just small time, not just 1.5-2 year. It's 10-year decadal, couple of decade story. Why would that manufacturing shift from China to India? We talk about China plus one. Because the working population of China will decline by around 14 crores over next 20 years. Whereas for India, it's growing by 18 crores. India's total working population today stands at around 54 crores. We are adding around 20% to that. 30% to that. So the China's manufacturing have to shift to India. Question comes, why did China's manufacturing started and why will it shift to India? 2004, when China became part of WTO, China invited all the MNCs to come and set up their shops in China. What happened? The MNCs asked them, will we get land? China said yes. Will we get laborers? Yes. Will we get power and energy? Yes. A lot of MNCs came and set up their shops in China at that time. And they brought their own technology, the high-end technology. what happened? The output of these MNCs was so good. The local manufacturing industry of China was supposed to compete with these MNCs within China. And hence the output quality of the local companies also improved significantly. That's why today people say no one is able to compete with China because of everything, be it quantum, quantity as well as quality. What is India doing today? India is giving incentive in the form of PLI, in the form of other incentive by the government. And we are inviting corporates to set up their shops in India. Last year, 2023, 28 new MNCs set up their shops in India. 10 were from US and five from South Korea. Another question comes, if China plus one is happening, shouldn't these guys shift to Vietnam? Or aren't these guys shifting to Vietnam? I'll say no. Same statistics for Vietnam for 2023. Around 23 companies set up their shops in Vietnam last year. 14 were Chinese. So the Chinese companies are shifting to Vietnam so that they can route via Vietnam. But the world have understood that. And hence international MNCs from US, South Korea, they are shifting to India. Everyone knows one example of Apple, the iPhone. They want to set up their shops in India. That is what is happening. Our labor cost, wages per hour, is around 30 to 35% discount to China. Our laborers, the quantum is very economical here. It's available in India. And last but not the least, I talked about the working population. I'll just give a statistics from a report of Apollo Capital. They originally said that by 2031, China's population will peak. But it already did in 2021. Since past 2 years, China's population is going down. The productivity ratio, human productivity ratio of China is 1. For Japan, it's 1.2, and for US, it's 1.4. Till the time I read that report by Apollo Capital, I never knew that the human productivity ratio of China is lower than that of Japan. Japan is at 1.2, China at 1. I didn't knew that. I don't know how many of you have heard about the same. So definitely, green shoots are there. Things are moving and moving in the right direction. How LIC MF manufacturing scheme would be different via others compared to others? Because this manufacturing in India is not just a short term, but it's a very long term story. 10 years, 20 years, of course, some volatility will continue because it's the characteristics of the market. Manufacturing, I mean, whenever we talk about it, as 15% of our GDP today is being contributed by manufacturing. Government have taken an aim that this should increase to 25% in the next 5-6 years. We have already started seeing the green shoots visible in the private segment capex. Most important in this would be India emerging out as a consumer. India as a consumer is already amongst the top 5 revenue generating countries for most of these MNCs. That's the key reason they want India not only as a manufacturing hub, but also as a consumer. So capex plus consumption, both these engines will fire together, or without one of these engines, we cannot be a Viksit Bharat, and both have to fire together and in speed. And it's already visible. I mean, we are seeing the numbers on a day-to-day basis as well. Import substitution, export promotion. I say whatever we consume in India, even if we produce that much, India will become a manufacturing hub. China, whatever it produces, around 50-60% of it they consume in-house. So that is what we want. Capex plus consumption, both will fire together. Coming to how are we LIC MF manufacturing scheme different? Three key things. One, we will be focusing primarily on the emerging themes here, the new young industries. When we talk of peers or the benchmark of manufacturing theme, we see a lot of large cap companies in the auto sector, in the capital market sector, primarily the large top 50 names being part of top holdings of these schemes. I doubt it would be for us because we'll be focusing more on the emerging themes, the young industries, young companies. Because our belief is if you have to invest in those large corporates only, why not go for a diversified scheme? Why to go for a manufacturing scheme? Of course, those will be part of our portfolio as well, but it would be only to give stability to our portfolio, not for alpha generating. Alpha would be generated by these new emerging themes, which would be the likes of solar, the likes of semiconductor, aerospace, defense, renewables. On this defense, just to give you an example, some of you might have a question that defense is too expensive. My view is it's a valuation. It's just a number. It's when you compare, how you compare, to whom you compare, gives you the answer. India's defense sector today is trading at around 35 times. You compare it 3 years back. 3 years back, it was trading at 10 to 15 times. Today, 35 times. Okay, I accept. It's expensive. Let's compare India's defense sector with US defense sector. You don't have growth visibility there. We have growth visibility here. You don't have order book there. We have order book here. You don't have, in India, we have 3 to 4 years of number visibility. We don't have that in US. Still, US defense sector is trading at around 80 multiple. We are just at 35. So we become economical compared to that. So valuation is just a number, depends upon what you compare, how you compare, with whom you compare. A lot of themes are emerging. On semiconductor, as I said, this is one of our key theme where we'll be investing. Or it's an emerging theme, nascent theme. Talk about semiconductor, what comes in our mind is just a chip. I say when we talk about semiconductor, for us, it would be the entire supply chain of semiconductor. I'll give you an example. Manufacturing of semiconductor require a very high purity water, less than 5 ppm. That water is not manufactured in India. But there is one chemical company who have manufactured this water at a lab scale. And they are developing to manufacture it at a commercial scale. If they are able to do that, that total addressable market, TAM, as we call it, increases from 9,000 crores to 1,10,000 crores. So for that particular company, what do I call it? A chemical company or a semiconductor company? No matter what do I call it, it's part of my emerging theme, the semiconductor theme. So this is where we'll be focusing on. How do we get these ideas? We get these ideas because of our research. 15-member team gives me capacity. 15 years of experience of that team, average 15 years of experience of that team gives me capability. So capacity and capability, which we have built in our investment department, helps us find out these unique ideas. Today also, we have around 20 to 23 unique names in our portfolio. How did it came there? Because of our bottom-up research idea. We don't mind if any other investor is there or not. But if it's a very good opportunity, it's very good. The risk reward is very favorable. It makes money for my investor, for my distributors. I will not miss out on that opportunity. Second point, why we are different compared to others, we'll be following PEG ratio here. A lot of these emerging themes, people say that it's expensive. Expensive means we talk about PE ratio. Let's put growth there. If your PE ratio is 25 to 30 times, but if your growth is 50%, is it expensive? No. So price, earning, growth. Let's combine all three in a ratio, PEG ratio, and use that to define where to invest. So we have defined PEG ratio as 1.2 to 1.8. Why 1.2 to 1.8? Because below 1.2, we believe it might be a value trap. Beyond 1.8, we believe it's too expensive. So 1.2 to 1.8 is a very good range. Companies which have reached this stage means they have passed the stage of being a value trap, and they still have opportunity to move beyond 1.8. So growth and multiple re-rating chances are still there. History proves, the numbers have already proven that this 1.2 to 1.8 PEG ratio have given better risk reward. The third thing, as I've already mentioned, why we will be different is our bottom-up research. The ideas thrown by our research. We'll be doing both top-down and bottom-up approach. But yes, the team strength, I have full confidence on my team. So manufacturing, because of these three things, will be different. And earlier I had told you that we are not late. So these are the two key things which we feel, these are the two key questions which I generally receive from my distributors, from my investors. And yes, we are not late. We are in time. It's just 1.5 years that a lot of manufacturing NFOs have been launched. Manufacturing, when we talk about what gets into our mind is we have to set up a plant. It takes 4 to 5 years to set up even a single plant. It's just 1.5 years that you have seen a lot of NFOs. Couple of them last month. It's a long-term process. And why are we different, as I mentioned? Focusing on emerging themes, focusing on PEG ratio, and strengthening or getting benefit because of our deep down research. So these were the key things on the manufacturing side. Shashank, any specific things on the manufacturing side or on our process? Definitely.
In fact, thank you so much. I have 4 questions. Actually, there are 4 questions. So maybe if we address them, few more things will get addressed on a whole. So I'll start bottom up. What would be your exit PEG ratio in future?
Okay. So exit PEG ratio for us will depend upon, we'll maintain our portfolio PEG ratio at between 1.2 to 1.8. Then depending upon corporate to corporate, we will take an exit call. We don't mind continue to book profit in specific stocks. But one more thing which we are majorly clear is we'll try to manage risk in terms of exposure to particular companies. We'll try to manage that at around 5%, beyond which we'll continue to book profits. And in terms of PEG ratio, of course, I agree, 1.2 to 1.8. But when stocks start rallying, sometimes you see that PEG ratio moves beyond 2.5 times. But then we have to look forward to that this PEG ratio would be 1 year forward. And if some growth is coming in from, say, 2 year or 3 year, a new capex is coming in, then probably we'll have to see from 2 or 3 year perspective. The average time horizon here we are taking is 3 to 5 years. So definitely at around 1.8 to 2 times, if we believe no more rise in PEG ratio should come, we might exit that. However, if a corporate is giving me around 30 to 40% earning CAGR, I might not exit. PEG ratio stability will give me an indication that beyond this particular thing, I will not get a multiple re-rating as well.
Great. Thank you. So the next question is, in defense, execution is key, however big the orders or order book might be.
So in defense, let me put this. I've already given example of defense about the valuation, because that's the key question which everyone asks. Aren't defense expensive? So in terms of order book, we have already seen multiples getting re-rated. Execution is definitely important, and we are waiting for those execution now. And that's the key reason why the defense sector is taking rest since past 3-4 months. We have to start seeing that in numbers now. So the first rally of these defense or PSUs also, orders came in. We have already re-rated them. Next is execution. When we start seeing the execution and start seeing it in numbers, that is when we'll start seeing the next leg of rally.
Great. The next question is, there's going to be a huge shortage for skilled workers in India compared to China. How would this be addressed going forward?
See, in terms of skilled workers, I agree there will be shortage. But yes, there are few companies which are already there in India, which are already working on this. And hence, I'll be frank with you, we already have exposure to those companies who are training the manpowers. So that is not an issue. Incrementally, most of the corporates themselves are working on this. In this year's budget also, we have seen the government is focusing on skilling of the manforce, skilling of the employees, the laborers. So a lot of tie-up work is going to happen. And internally, each corporates will be working on this particular thing.
Great. The next question is the fund immune to any Indian politics? What drawdown can one expect in worst case scenario, and what is the best performance one can expect?
Okay. So I didn't mention about the risk. So one is geopolitical risk. Second is internal political risk and stability of government policies. So definitely, if Indian politics takes some or the other shape, our market definitely will react to that. Our fund also invests in that market only. But more important for us is not the political scenario, but the stability and consistency in these government policies. That becomes the key risk for a manufacturing fund. No matter government changes, but if there is consistency in these policies, we might not see a major impact on the manufacturing as such in India. In terms of drawdown, see, 10 to 15% correction is anytime given. Today, we don't say that as correction. It's basically a volatility. When we talk about last 35 years, more than 10% correction has happened just 5 times. And today, what's beneficial for us is common man's money. We talk about flows, but this flow which we are seeing is structural, which is happening. It's not that we have already seen few volatility, few corrections in the past couple of years, but we have never seen flows going down. In fact, every time the common man rises stronger than the earlier time. And in terms of upside, let me put it this way. We have to increase our per capita from $2,600 to $18,000. Huge opportunity, huge.
Why $18,000?
That is when you become a developed nation. And by 2047, we have to become developed nation, Viksit Bharat.
So how much CAGR it turns out to be?
So in terms of per capita, it turns out to be, I mean, in single digit only. But that single digit itself is very huge when you convert that into manufacturing, because more than 50% of this have to come via manufacturing. We cannot become a developed nation without manufacturing.
There are 2 more questions in the chat box.
Yes,
Which
please.
sector do you give more weightage?
So in terms of sectoral, we'll be focusing on emerging themes, as I told you, like semiconductor, aerospace, defense, chemicals, auto ancillaries, not OEMs, primarily ancillaries, because they are the ones who supply both to autos, your off-market, everything. we generally go by bottom-up approach. So it's more company specific for us. And if that gives me an opportunity, I'll try to have that in my portfolio. In terms of sectoral, it's generally automated. So whatever corporate I choose, it goes into the respective sectors. So for manufacturing as a whole, when we talk about sectors, generally what everyone says is it means X, IT, and BFSI, everything is manufacturing. My view is different. I say it's only IT. Why BFSI? We have seen consumption funds. They have exposure to financial sector, to banks. When asked, they say that banks go for retail lending, personal loan. That's consumption. So it's part of consumer fund. I say then banks also lend for this manufacturing and capex. So it's an indirect exposure to manufacturing. So I'm not saying that we'll have BFSI as part of our portfolio. I'm just saying that if sectoral theme is working, we won't mind allocating some amount as tactical allocation to this BFSI as well, if we see some opportunities in short term. From a long-term perspective, it would be primarily manufacturing, X, IT, and BFSI. But if there is some short-term opportunities, we'll grab that as well.
Okay, before I read out the next question, I would request all the participants to put out their questions in the Q&A box instead of the chat box. So the next question the gentleman is asking is, are you also bullish on the shipping sector? Likewise, defense valuation you mentioned.
Definitely, see, our Prime Minister already unveiled a new waterway for shipping from here to Europe. A port is being set up for that. That has already been announced. You would require huge ships. Shipping sector definitely is positive. Of course, we need to look for valuations. I won't name the company, but yes, valuation there are too expensive. I agree with that part. But there are a lot of ancillaries in the shipping industry. Those are very economical. I'll just give you an example. A company manufactures the rods which are used at the bottom of the ship. Basically, the wooden part which we stick to those particular specialized steel rods. Those rods are used in ships and in now they are working with our Navy as well. Earlier, these parts were imported from Russia. Now that company is the only manufacturer in India. That is not expensive. I'm not saying we are buying something like that. What I'm saying is opportunities are immense. We just have to find those opportunities. 5,600 companies which are listed X of large cap and mid cap. We have to find those 40, 50 or 60 opportunities in that 5,600 corporates.
There is one more question. Is this fund a mix of all major themes, or is it concentrated to a particular theme?
Mix of all the major themes, primarily the emerging ones.
Okay. I have some questions, Nikhil.
Please, sir.
One is that while I'm really very positive on the manufacturing segment per se, because of not just what you mentioned, but also I believe that this is one sector which creates tangible assets. And unlike so many other industries where you don't get to see the tangible assets, this creates physical, tangible assets, right?
Yes.
And I also believe that in terms of employment generation, this particular sector brings in a lot of strong push for employment creation. Maybe some of the sectors like in IT, maybe that also creates, but that is more transient rather than permanent nature in what is like in the manufacturing sector. Because the projects are huge, the projects are long-term, very long-term, most of the time perpetual. So the employment creation is of more of a permanent nature than compared to the services industry.
Right.
In that background, I would try to understand as to, since you mentioned that you would be focusing on the emerging sector more, emerging theme. would it mean that you would focus more on the mid and small cap segment? Despite the fact that you mentioned that you would have a large cap exposure for stability, but the large cap is overexposed and over researched, and everybody knows what are those stocks going to be. So, but they're going to be there to what extent, and just to provide stability, and therefore the focus is going to be more on the mid and small cap in terms of percentage weightage, also in terms of the theme.
Sir, yeah, you are absolutely bang on. Our exposure to mid and small would be higher because all these emerging themes are coming in this mid and small cap. In fact, small cap, not mid cap. Uh, in terms of percentage, it would depend upon the market conditions. If we believe that the market is too volatile, if we believe there is some amount of time correction or absolute correction which is visible in the market, at that time our ratio of large cap might increase, because these large cap companies, they are not ready to lose their positions of top 100. So all the new companies are coming in those small cap category only. But when I talk to my friends who sit outside India, and when I tell them the $3.5 billion company in India is a small cap, he laughs at me. Today our mid cap cutoff is at 67,000 crores. A $8 billion company is just a mid cap. So I'll put it this way, that the bar for small and mid cap have actually risen. And most of these emerging themes actually are coming in this category. If you look at our other products, the existing products like multi-cap or large and mid cap, there also you will see we are small and mid cap heavy, and those products are performing very well. And we are managing large cap weight primarily for stability to the portfolio. So definitely I won't give you a number that what would be minimum or maximum small and mid cap or large cap. But I'll say, depending upon the market conditions and fund managers' conviction, we will manage that dynamically.
So I'll extend that question by asking another question, is that what is your targeted portfolio beta?
Sir, we'll focus more on Sharpe ratio rather than a beta. As of now, in other schemes, if you see, our beta is around 0.7 to 0.8, but our Sharpe ratio is around 1.4 to 1.5. That is what we'll be targeting, because we believe instead of increasing beta, let's focus on increasing our Sharpe ratio.
So I would request, I think there are two more questions in the Q&A.
Please.
Is it okay if we continue those two questions?
Please
sir.
go ahead.
Yeah. So in this fund, do you consider data center theme?
Yes. It's so Shailesh will send out a presentation wherein we have clearly indicated what is our focus sectors, and their data centers are also there, chemical, auto ancillaries. So a lot of things are there, and that PPT will be with you guys soon.
Sure. What is the targeted portfolio size in terms of number of shares you're looking at? How many stocks you're looking at?
So scheme size is small. If it is small, then 40 to 60. If it's large, then around 70 to 80.
So that means on an average per stock weightage, you're looking at highest allocation of about 5%?
Yes.
Maximum?
Maximum 5%. Yes.
Maximum 5%. And
I mean, I will not stop there. If something is opportunistic and if it is going beyond 5% because of passive breach, active breach, we will not do beyond 5%, but it might happen because of passive, because that stock is going up.
Right.
There we will continue to book profit, but yes, passively it can go beyond 5%.
Does it also mean that you'll have a long tail in the portfolio? Below 1%?
I don't think so, because around 70 to 80 is what we are maintaining in our largest scheme as well. And in our smallest scheme, we have around 45. So around 45 to 80 or 90. So tail would also be around 80 to 90 bips.
Okay. All right.
As a house, just to continue that, as a house, what we believe is, if there is a tail, I mean, if I have around 20, 30 bips of a particular script in my portfolio, even though that script doubles,
Exactly.
Neither my investors nor my team will benefit because of that, but we have to do additional work of maintaining coverage on that particular script.
So how many stocks do you look at allocating less than 1% out of 70 or 80?
It would depend upon the liquidity of the stock. I would like to allocate around 1% at least to everything.
Okay.
But it also depends upon the liquidity and the price at which I want to get in.
But tail as a whole would not exceed 10%.
Correct. Definitely.
That ballpark, if I can,
Yes. Yes.
Sure. Perfect. So any other questions, please type in into the Q&A box. Meanwhile, I would request Shailesh to share his perspective if he needs to, if you can add few more things.
Yeah, Shashank, can I ask a couple of questions?
Yeah, please go ahead.
Sorry, Pankaj. Yeah, please.
Yeah.
Please go ahead.
Hi. Okay, so like the last 3-4 months number, which I'm seeing this Amphi number. Okay, thematic is and sector, they are getting around more than 15,000 crore every month inflow. So just wanted your view, like why we are getting so much, like whether it's manufacturing or energy, like every month it's like that, last 4 months.
So, see, you guys are more experienced than I am, but in a bull phase, we have 3 phases. First, when everything works. The second phase, when your themes and sectoral works. And the third phase, when your stock specific works. We are right now in the fag end of the second phase, second part of the bull phase, wherein your thematic and sectoral are working. That's why a lot of money is going there. Going forward, we see stock specific things work coming more into play. And that is when the research or bottom-up research helps a lot.
Okay.
So right now we are in that second part of the bull phase where your sectoral or thematic works a lot. And hence, since last a year or so, we are seeing a lot of money going into those thematic and sectoral.
Okay, thanks. So how much one investor should allocate in this kind of investment out of his portfolio, total portfolio?
So when anyone asks me about the total portfolio, I generally tell him like 40 to 45% should be allocated to the likes of BAF or multi-asset. Around 40% or 35 to 40% should be allocated to diversified funds like large cap, mid cap, small cap. 15 to 20% should be allocated to thematic or sectoral funds. But just to give one clarity, manufacturing theme is neither a sectoral nor a thematic, which everyone talks about. As I pointed earlier, ex-IT, everything becomes part of manufacturing. So how come this is sectoral or thematic? This becomes a core diversified fund, ex-IT.
Okay. Yeah, thank you.
Perfect.
Pankaj is our head of products.
Perfect. I hope I was able to convince him.
Yes, very much.
Shailesh, please, over to you.
So I think it's a great opportunity. As I mentioned, ki manufacturing is the way forward. If the country has to grow, it has to be Atmanirbhar, and Atmanirbharta comes if you manufacture things in-house, whether it is a pin or a plane, everything has to be manufactured within the country. And this is what we are seeing in our defense industry to begin with, supported by PLI across. And at times you are mentioning about geopolitics. Geopolitics could work in your favor also. What has happened in Bangladesh? Look at the price of the textile shares, how they have shot up. And it again gives us an opportunity. So any crisis is a crisis as well as it gives birth to an opportunity. So for our country, with our talent pool, a young population, and with the ambition to cater to the world, make in India, make for the world, I think manufacturing is the best suited theme. And this is a theme which will be an evergreen theme. It is not for 1 year, 2 years. This will be continuing for 5 years, 10 years. With this, I sum up my conversation because time will also be restricted. And if anybody has any other questions, or if Nikhil has to put something, and if you have to put something, we'll be happy to add.
Yeah, there's one more question. What is the benchmark for this fund, benchmark index? And what is the CAGR of this benchmark for last 3 years?
It's the manufacturing index, which is there. And the CAGR, earlier, there were not many companies which were part of this. Today, if I have to give you a breakup, around 31-32% is auto entities. So not much output will get from this benchmark. I would rather suggest, I mean, even in-house, we rather focus on the peers that we want to be in Q1 or upper Q2. Benchmark will beat every time, but we have to be in above average, which is above majority of our corporates. Around, I believe, 8 schemes are there here. We'll try to be in top 3, 4. In terms of number, I suggest that we should not look at the manufacturing. I, as an individual, don't want to focus on that because 31-32% are these auto companies like Maruti, Tata Motors, and the likes. So,
as an individual, I have a question that if I invest in this fund, next 3 years, what kind of CAGR I can expect? I'm asking
Sir.
3 very, very leniently.
I mean, this we can answer you one-to-one, not in an open forum.
Then for the benefit of my investors and partners,
sir,
this is a question I'm asking on their behalf.
Sir, I'll see, Shailesh said beat the benchmark. I'll say we will try to maintain our Q1 or upper Q2. The system and the process changes which we have done in the past 3-4 months in LIC, what we want is all our equity schemes should perform strongly. Today, out of 13 equity schemes we are having, 11 of them in the past 6 months are in Q1.
Hey, a Q1, Q2 is good for investment team, but not for investors.
Correct.
So if I rephrase the question, which is that Sensex or Nifty plus how many percentage points?
So
on a best case basis, and on a worst case basis, Sensex minus how many basis points? How many percentage points?
So, see, this theme, if I have to look at XIT, basically it's the entire universe XIT. Then it would be broader market plus 4-5% and broader market minus 4-5%.
Okay. Okay. Fair enough. Fair enough. So I finally got you.
So,
all right. Pankaj,
I would just like to add one thing in continuation to what we have covered. Why are we in a sweet spot? We are in a sweet spot globally also. Today, the entire world is looking at a China +1 for resources and a Europe for +1 for resources. So that also ideally matches the vision of manufacturing in India.
Sure. Correct.
So lastly, if you can just let us know what's your house view on the equity side. Market has moved up so much.
Yeah, that will be quick because we have last few minutes. So Nikhil, I request you to please share your house view.
So this actually is the first question which I generally get whenever I go to meet someone. So let me put it this way. We talk about that market is at peak. I agree market is at peak, but our valuations are not. Large cap valuation, we are at average of last 10-year median average. Same thing. We expect, I mean, this year FY25, in terms of earning CAGR, we expect that it would be around 12-13% compared to around early 20s in the past couple of years. For FY26, we expect around 16-17% growth, and similar would be the growth given by the market as well.
All right. Thank you so very much, Nikhil and Shailesh. It was wonderful listening to you. Thank you so very much for your time and views. On behalf of Team PL, we assure you we'll do our best.
Thank you. This is the best line of the entire session today.
I know. I wanted to leave you with a lot of pleasant.
Thank you. Thank you so much. Thank you for your
participants. Thank you so very much.
Thank you.
Thank you, everyone.
See you soon.
Thank you.
Bye.
Bye.